The fiscal landscape of the United Kingdom operates on a principle of voluntary compliance via the self-assessment system. However, beneath this veneer of trust lies one of the most technologically advanced and legally empowered tax enforcement agencies in the global economy, His Majesty's Revenue and Customs, HMRC. In the current fiscal year, the tax gap, the difference between the tax that should theoretically be collected and the amount actually received, has become the primary focal point of government policy. To bridge this gap, HMRC has shifted from traditional, random audits to a data-driven, risk-based intelligence model. This transition means that tax investigations are no longer arbitrary. They are the result of sophisticated algorithmic flagging and cross-jurisdictional data synthesis. Understanding the mechanics of a tax investigation is not merely about fear. It is about understanding the rigorous standards of documentation and transparency required to survive the scrutiny of a modern digital audit. In this deep dive, we will analyze the technical triggers, the systemic architecture of surveillance, and the legislative protections available to taxpayers. At the epicenter of HMRC's enforcement strategy sits the Connect system. This is a multi-billion-pound analytical engine designed to synthesize vast quantities of unstructured data. Unlike traditional databases, Connect utilizes social network analysis, SNA. This methodology does not view a taxpayer in isolation. Rather, it maps the entire web of relationships, familial, professional, and financial, that surround an entity. The system ingests data from over 30 distinct streams. These include the Land Registry for property transactions, the DVLA for high-value vehicle registrations, and the merchant acquirer data, which tracks every credit and debit card transaction processed by UK businesses. The primary trigger within this system is financial inconsistency. When the mathematical projection of a taxpayer's lifestyle calculated through mortgage payments, insurance premiums, and asset acquisitions exceeds the declared disposable income on a self-assessment return, the system generates an automated risk score. A high risk score is the fundamental catalyst for a formal inquiry. The technology is designed to identify lifestyle mismatches with a degree of precision that makes traditional concealment methods obsolete. A significant percentage of HMRC investigations are triggered by outlier detection through sector-specific benchmarking. HMRC maintains a comprehensive economic profile for every standard industrial classification, SIC code, in the UK. These profiles contain granular data on expected gross profit margins, net profit ratios, and typical overhead structures for businesses of varying scales and geographies. When a business submits figures that deviate significantly from the statistical norm of its peers, it triggers an anomalous reporting flag. For instance, if a service-based business reports a cost of sales ratio that is statistically improbable for its sector, HMRC will investigate whether private expenses are being misclassified as business costs to suppress taxable profit. Furthermore, HMRC analyzes year-on-year volatility. While businesses naturally fluctuate, sudden drops in turnover or unexplained spikes in administrative expenses without a corresponding shift in market conditions are viewed as indicators of potential yield testing or income suppression. Stability and alignment with industry norms are the hallmarks of a low-risk tax profile. The introduction of the model reporting rules for digital platforms has fundamentally altered the detection of side income. Under current legislation, digital intermediaries are now mandated to perform the role of information agents for HMRC. This creates an automatic data feed where income earned through digital marketplaces is reported directly to the authorities, bypassing the taxpayer's discretion. Simultaneously, the Common Reporting Standard, CRS, facilitates the automatic exchange of financial account information between over 100 jurisdictions. This international framework means that HMRC receives annual reports on offshore bank balances, dividends, and interest earned by UK tax residents abroad. The requirement to correct RTC legislation further strengthens HMRC's hand, imposing severe penalties on those who fail to disclose foreign liabilities. This global transparency network has effectively eliminated jurisdictional secrecy as a viable method of tax mitigation. The integration of these global datasets into the Connect system allows HMRC to conduct worldwide income verification with unprecedented efficiency. A tax investigation typically manifests in two forms: a full inquiry, which examines the entirety of a tax return, or an aspect inquiry, which focuses on a specific discrepancy. HMRC's powers during these proceedings are governed by Schedule 36 of the Finance Act, 2008, which grants them the authority to issue information notices. These notices legally compel the production of documents that are reasonably required to check a person's tax position. However, taxpayers possess statutory protections. The principle of statutory records limits what HMRC can demand, and the legal professional privilege protects certain communications from disclosure. To mitigate the risk of an investigation, proactive disclosure via the Any Other Information section of a tax return is essential. This allows for the preemptive explanation of unusual transactions, potentially satisfying an inspector before a formal inquiry is launched. Additionally, the maintenance of a contemporary audit trail where every digital transaction is mapped to a physical or digital voucher serves as the ultimate defense. In the event of a discovery assessment, where HMRC reopens closed years due to suspected non-disclosure, the burden of proof often shifts, making robust, multi-year record-keeping a non-negotiable requirement for financial security. In the contemporary era, tax compliance is no longer a periodic obligation but a continuous state of financial transparency. The synthesis of artificial intelligence, global legislative cooperation, and mandatory digital reporting has created a panopticon of fiscal oversight. An HMRC tax investigation is a rigorous process designed to verify the integrity of the UK's tax base. For the taxpayer, the most effective strategy is not the avoidance of the system, but the mastery of it. By aligning financial reporting with industry benchmarks, maintaining impeccable digital records, and understanding the technological triggers of the Connect system, one can navigate the complexities of the UK tax regime with confidence and security.